In this video we will learn about IAS 8, accounting policies, changes in accounting estimates, and errors. IAS 8 has not been superseded by any new standard. So far IAS BS Work Plan 2024 does not list IAS 8 for major revisions. Objective of IAS 8. IAS 8 prescribes the criteria for selecting and changing accounting policies, along with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and corrections of prior period errors. Key components of IAS 8 are 1. Accounting policies. 2. Changes in accounting policies. 3. Changes in accounting estimates. And fourth one is corrections of prior period errors. Now let's take a look into these key components. 1. Accounting policies. Accounting policies are specific principles, bases, conventions, rules, and practices applied in preparing financial statements. Its selection criteria is 1. Policies must comply with applicable IFRS. 2. If no IFRS standard applies, management must use judgment to develop policies that provide relevant and reliable information. Accounting policies consistency. Accounting policies should be applied consistently for similar transactions. At number 2 we have changes in accounting policies. It is the subsection of component 1. Changes in accounting policies are allowed only if 1. Required by a new IFRS standard, and number 2. It results in more reliable and relevant information. Accounting treatment. It applies retrospectively. And now how to disclose. Firstly, its nature and reason for the change should be described clearly. And secondly, its impact on financial statements. Third component is changes in accounting estimates. Definition: adjustments due to new information or developments. For example, depreciation method revisions, bad debt estimates, etc. Now, accounting treatment. Apply prospectively. Its disclosure, nature and effect of the change should be disclosed clearly. Fourth component is corrections of prior period errors. Definition: mistakes or omissions in prior financial statements, for example, mathematical errors, misapplication of accounting policies. Accounting treatment. Apply retrospectively. Disclosure: 1. Nature of the error. 2. Amount of correction for each period. 3. Its financial impact. Importance of IAS 8. 1. It enhances comparability and consistency in financial reporting. 2. It ensures transparent disclosure of policy changes, estimate revisions, and error corrections. 3. It helps users understand the impact of adjustments on financial performance. IAS 8 plays a crucial role in maintaining the reliability and credibility of financial statements under IFRS. Summary of today's topic. 1. Policy change treatment should be applied retrospectively. 2. Estimate change treatment should be applied prospectively. 3. Error correction treatment should be applied retrospectively. What is retrospective and prospective effect? Retrospective is applying changes to prior periods, as if the new policy or estimate had always been used, like restating past financials. Prospective is applying changes from the current period forward without adjusting prior periods, this impacting only future financials. That sums up our today's topic. If you have any question, ask me in the comments section.